Hello, Business 500D students. This is Professor Hassey. It's week 5 lecture video for the week of July 4th to July 10th. Problem is, today is July 10th, the last day of the week, and I apologize for that. But our topic this week is cost of capital and capital valuations, chapter 7, 9, and 24. I'm going to review those definitions and look at some samples or examples in today's lecture video. This will lead up to our assignment number 3 work, which will be posted this coming Tuesday, July 12th, and due on Sunday, July 17th. And then next week, in week 6, we talk about capital budgeting. Also this week, you have your assignment number 2, which is due today, July 10th. And please post your work for that assignment. And I'll get the grades back to you in the coming week. So let's just take a look and update ourselves where we are in our Blackboard right now. Okay, if we look at our schedule, just to update our schedule, you have assignment number 2, which is due today, July 10th. You have an assignment number 3 next week, which I'll post on Tuesday, which will be involving with our discussions of chapters 7, 9, and 24. Then you have an assignment number 4, which will be involving capital budget analysis, chapters 9, 10, 11. And that leads up to the final week, our final examination, which is due July 31st. So we're more than halfway through our course and reviewing some of the key concepts of corporate finance. If you go to week 5 this week, you'll see our learning assignments for the week. That's graded work on July 10th, which I checked before I started this video today. All but one of you have already posted that work. So please make sure you post your work by midnight tonight. In the capital week 5 area is some PowerPoints of the 3 chapters from our textbook. This review spreadsheet, which I'll be going over in class in this lecture video. And then some 3 videos that I'm not going to show you in this lecture video, but I'd like you to review. You can watch them right from here or watch them in our YouTube playlist for Business 500D. 3 videos that I'd like you to watch, fairly short, all about 10 to 14 minutes long each. A definition of weighted average cost of capital, chapter 9, and some excellent definitions of bankruptcy from chapter 24, liquidation bankruptcy, what's called chapter 7 bankruptcy, and restructuring bankruptcy, chapter 11. I strongly urge you to review those videos for this week's work. Okay, we talked a little bit about stocks. We mainly talked about bonds last week. Excuse me. But we also are talking about stocks and stock valuation. Remember, there are 3 ways that a company can acquire assets, capital for investment to generate profits and cash flow. It's issuance of debt, and for the corporate world, that's bonds. The issuance of equity in the corporate world, that is stock. And the third way is making a profit. It's as simple as that: debt, equity, and profits. So as we went over bonds last week, bonds are a pretty good thing because the investor and the issuer of the bond knows exactly when the interest payments are due and when the principal is due to be paid. Stocks are another matter. Stocks, the main sources of return off stocks are naturally, 1, dividends. But those dividends are not guaranteed unless it's a preferred stock, but not too many companies issue preferred stock. Dividends are determined on a quarterly basis by the board of directors of a company, on the direction of management. You never know what you're going to get a dividend or how much it will be. Yes, companies try to stay consistent in that regard, but it's difficult. Again, also, who knows what's going to happen to the stock price? Stock price could go up in a good market, could go down. It's all based on what the market feels is how the company is performing, but also how's the company performing in the current economic conditions of that particular countries they do business with. So stock is very tough to figure out. So in stock, we have two ways of measuring. It's called dividend yield, and capital gain, stock price going up. If I buy a stock and it pays me $4 a share in dividends, that's a return. If the stock price goes up from a purchase price of $20 to $22, I make a capital gain of $2. All of those are taxable as regular income. The dividend is taxable and the capital gain is taxable. So why do we get into the stock market with so many uncertainties? Well, there's a great opportunity of making money. Over the last 60, 70, 80 years, the stock market has outperformed all other investment vehicles. That includes bonds, it includes gold, it includes oil, it includes commodities. Stocks outperform. Why? Many people invest in stocks for the future, not the short term, but the future. And usually that future pays off. So one of the constant ways of trying to get into the stock market, and something that a corporate financial person has to be aware of, is how does the market perceive the true value of the stock? A stock could be a certain value in the stock market, but is that its true value? Is that what really it represents? Many times the market overvalues or undervalues stock. Remember, the market is just supply and demand. The market is driven by the performance of the company, driven by the economic conditions, but it's all supply and demand at the whims of the market. What is the true value of a stock? Well, the textbook and I like to use what is called the constant growth model. If you know three things, you know what the anticipated dividend is going to be paid by the company in the next year. If you know the current forecast of growth, the current expectations of return by the investors in the market, and if you know the expected growth of the stock, two of those things are given every quarter by the management of the company. It's required by law. Every 3 months, the company has to do a financial report to the market indicating what's their planned dividend to be paid out over the next 12 months and what's their plan or what's their anticipated return and growth of the company. So if I know that my stock is going to be paying 54 cents a share in the next year, if my company expects a 7% growth rate, and if I anticipate personally a 9% growth, I put that into a formula called the constant growth model, which dividends divided by the difference between expected return and expected growth, I will get $27 a share. That's called the intrinsic value of the stock. What does intrinsic mean? What's the true value of the stock in relationship to market indicators? Dividend, expected return, and expected growth. Now, if I call up my broker and the broker tells me the stock is currently trading at $30 a share, I don't know if I'd buy that stock because it's overvalued. Its true intrinsic value by the constant growth model is really $27 a share. So I would stay away from it. So one of the key indicators of this formula of constant growth, which is expected, we will talk more in just a few minutes, is the expected return that investors expect from the stock in the current market. Another name for that expected return is the capital asset pricing model, which determines the required return rate by an investor in current market conditions. We'll talk about that in just a minute. So stock is an interesting animal. It's all based on the future expectations and performance of the company in the industry and market that they're in. Nothing's guaranteed. No dividend, no stock growth or stock drop. It's all based on the future. And how you manage that as an investor is you're like betting, gambling on the future, but you're using trends, you're using historical performance as a gauge to offset that risk. As a CFO or a financial manager of a company, You use the history of the performance in the company to make it more efficient, less risky, more attractive to the investor by running the business efficiently and with less risk. Sometimes a tall task these days of the post-pandemic high inflation world. So this all leads us to, from chapter 7 to chapter 9, which is called the cost of capital. It's better yet, as the video shows you in week 5 of our Blackboard, it's the weighted average cost of capital. What that means, it's what does it cost the company today under their current capital structure to get assets? What's it cost them? And the capital structure is what percent of the assets are funded by interest-bearing debt and what percent of the assets are funded by stock and retained earnings. So as you see in this example, the capital structure of this company is 44% debt and 56% equity. It's got to equal 100. So that's our capital structure, which drives the weighted average. So what then is the cost of debt and what is the cost of equity? Well, the cost of debt is the after-tax cost of debt that it's costing the company to borrow the money. Let's look at this example. If my interest rate on some borrowed money is 10% and I have a 40% tax rate, my after-tax true cost of debt is 6%. Why? I get to deduct 40% of the 10% as a tax deduction, corporate tax deduction, interest. So yes, I'm paying 10% out to the people who lent me the money, but I get to deduct part of that on my taxes. So my true after-tax cost of debt is 6%. Cost of equity is determined, as I mentioned earlier, by the capital asset pricing model. It compares the company's risk in the market, which is called the company beta, to the average risk in the market and the risk-free rate in the market. Now I'm going to change these calculations now because I'm bringing a little bit more up to date to the real world. Right now, the risk-free rate is approximately 3%. That's the 10-year United States Treasury yield. That's the current risk-free rate. It's currently 3%. The market return rate now is about 9%. 9%. And this company, with the capital structure of 44 and 56%, this company's current beta in the market is 1.5%. That's its current risk in the market. Hopefully some of you remember beta, but beta is a statistical standard deviation risk analysis comparing the returns of a stock of a company over 4 or 5 years and every quarter compared to the average return in the market. That's the beta. So if the company has matched the market return of 9%, their beta will be 1. But as you can see, the company's beta is 1.5. Thus, they have a little bit fluctuation between that return of 9%, a little bit risky. So if I wanted to determine the expected return of an investor, I have to gauge the relationship of making 3% at no risk to 9% at average risk, and what would be the percent at my company's risk of 1.5. Well, the required return, or the capital asset pricing model, is the risk-free rate plus the market premium times the beta of the company. The market premium is defined as the market return minus the risk-free rate. So putting that into this equation, and let's update the numbers, our risk-free rate is 3.00. Our market premium thus is the market return rate of 9 minus the risk-free rate of 3. That will equal the market premium. And the company's beta is 1.5. So 3% plus 6% times 1.5. So if I put that into our equation and update the numbers, 3%, 9% times 1.5. We get a beta or a expected return, ouch, of 16.5%. Pretty high. Why? High risk. The beta is substantially above the market return. I think I did that wrong. Let me double check my arithmetic here. Double check that. 3%. Let's double check this. I'll redo it just to be on the safe side. So 0.03 plus 0.06 times 1.5. I think I did that right. So now we see what this equals. 12%. There we go. That makes sense. Had too many parentheses in my original one. So 12% is the expected rate of return. 3% plus 6% times 1.5, 6% times 1.5 is 9, plus 3, 12%. So it's costing this company, and these numbers change every month, every quarter, and they're constantly being updated by a company. It's costing them 6% after taxes to borrow the money. It's costing them 12% to make sure they get an adequate return to the investors who are invested in their stock. So if I take my weighted average cost of debt, 44% times 6% is 2.6. 56% times 12%, update these numbers. My weighted average cost of debt is 9.36%. I'm taking the after-tax cost of debt times the percentage of the business that's funded by debt, 44%. I'm taking the expected return demand of the investors, the cost of equity, times the weighted share of the capital structure of equity. I weight them, add them together. It's costing this company 9.36%. And what they talk about in Chapter 9 is now you can take that interest rate of WACC and divide it into the free cash flow of the company to get the value of the corporation. If I take 9.36% and divide that into an annual cash flow of $1 million, their company's value is $10,683,761. You can determine the value of a corporation by taking what it costs them to make their money and divide it into the free cash flow that's generated from that asset. Remember, the definition of free cash flow talked about in Chapter 9 is the amount of cash that's left over after all the working capital and long-term capital requirements of the company have been funded. They're making $1 million a year. So notice if my WACC was lower, notice what happens to the value of the company. Cheaper money, higher value. More expensive money, lower value. One of the main reasons why companies are freaking out today about high inflation. It's going to cost them more to get their assets in higher inflation. That will reduce the value of the company, will probably hit their stock price and make things a little bit more difficult for them to raise capital. That's why inflation scares managers. So the cost of capital is that mix of debt and equity and what it costs that debt and equity, and combined will give the cost of capital. Why do we study cost of capital? Because it's part of the capital budgeting process, which is week 6. We make an investment. We fund it by borrowing, issuing equity, using profits. It has a depreciable life, 10, 20, whatever years. It creates revenue and expenses. It creates net cash flow. That cash flow is then determined by 4 different analyses dollars net present value, percent internal rate of return, a ratio profitability index, and years payback to determine their return. Is it a viable investment? A risk assessment is done using scenario and sensitivity analysis. This is going to be our topics in chapters 9, 10, and 11 next week. The capital budgeting process. So WACC is a part of that. It determines the cost of capital to be used in a capital budgeting process. So review this. It's a combination of bonds, debt financing for corporations usually, and stock financing, equity financing, and how to gauge those costs by company and how to gauge those costs as a weighted average to the overall way the company is made up of mix of debt and equity. Very important. We'll look at a problem next week that combines all this. So if a company fails, if a company's ways of getting stocks and bonds and financing investments does not generate enough money to provide adequate cash flow to pay back investors and require capital to grow and stay competitive in the future, there is what is called bankruptcy option for companies. And in the United States, there's two types of bankruptcy by the bankruptcy law. Chapter 11 bankruptcy is giving an opportunity to reorganize the business. Chapter 7 bankruptcy is liquidate the business. In other words, if I'm a stockholder, if I'm a bondholder of a company that goes Chapter 11, I'm still going to get paid because they're going to reorganize the company's finances and still pay me. If I'm a bondholder and I'm in a Chapter 7 bankruptcy, I'm still going to get paid as well. Probably not entirely everything, but I'm still going to get some money because the liquidation would sell off assets and pay me. But on the other side of the coin, if I'm a stockholder in a company and a company goes Chapter 11, I lose all my equity value. The same thing with Chapter 7. Because usually there's not enough money or liquidity in the assets to pay off everybody. Remember, you got to pay bondholders, you got to pay tax bills, you got to pay pension funds. By the time all these bills and liabilities are paid, there's no money left for the shareholders. That's one of the attractiveness of being a bond or lender to a company. You're going to eventually get paid. With a stockholder, it's all gone. Chapter 11 and Chapter 7 are not a good thing. So if you hear rumors that your company is thinking about bankruptcy, as a shareholder, you should fight those rumors and tell the company, no, keep struggling. Yes, the stock price is probably way down, but I still own something. Once you file bankruptcy, your stock value is gone. Something to remember about bankruptcy. All the methods that companies use to attract capital and make business, make profits, make income is to avoid where you have the situation where there's more liabilities than there are assets. Because when that happens, you're in bankruptcy. So there's a couple great videos in Blackboard that explain this situation, and please study up on them because you're going to have a question next week about bankruptcy in assignment number 3. So these have been the key points of cost of capital and capital valuation. I point out to you, please make sure you understand and review the constant growth model of determining a stock price. Please understand the makeup of a weighted average cost of capital. And please understand what's the difference between Chapter 7 bankruptcy and Chapter 11. These will be in our questions in assignment number 3, beginning this coming week, due on Sunday, July 17th. So thanks, everybody. Look for my video for week 6 around Wednesday. And if you have any questions or concerns, please let me know. Have a great rest of the weekend, and we'll see you soon. Bye-bye.